How are you?
I am great, brother. How are you?
I'm excellent. This is round two.
Round two. I know that. I mean, I actually went back and watched round one, by the way.
I should have done that.
It was
That was
good. It was really good. I don't know why I sound so shocked. It was really good. You did a much better job than I did. You were very articulate, very intelligent, sounded really smart.
a shocking performance.
Welcome to Teague Talks. I'm your host, Teague Hunter. Today we're sitting down with Jon Stanner, President and CEO of Summit Hotel Properties. We're going to find out what life is like in the hotel REIT world, find out what Summit's been up to for the last 6 months, and Jon's outlook for the future. Thanks for joining. Oh, there he is, the man, the myth, the legend, Jon Stanner. How are you, brother? Thanks for joining me.
I'm wonderful. How are you? And
How you
thank you
been?
for having me.
Happy 4th. Did you do anything fun? Have you traveled anywhere? What'd you do?
My wife and I both grew up in the Midwest, so we make the trek back over the 4th of July every year. My wife's family's in Iowa, mine's in Indiana, so we cover all the I states and get to see some family and get out of the heat for a week. So we had a really nice time.
When's the last time I saw you? Whether you're at a conference or hell, coming to Atlanta for a Braves game.
That's right.
I just walk around for 2 hours because that's how I baseball.
Yeah. I guess we last saw each other in New York,
Oh, that's New
which
York.
feels it feels like a lifetime ago, but was probably only a month ago. But NYU, the NYU NAREIT week is a busy week, an efficient week for us, but it seems like a really long time ago at this point.
So what are you hearing? What are you seeing out there? What are you learning in the publicly traded space? What are you seeing?
Look, it hasn't been, I think fundamentally things are okay. We had a really good first quarter of the year. I think particularly on a relative basis. We didn't expect the first quarter to be kind of our highest RevPAR quarter of the year, but our RevPAR was up 1.5%. I think probably, the better story for the quarter was just the job that the team did from a margin perspective. And on the bottom line, our EBITDA was up 6% on a same store basis. And at the corporate level, we're up almost 10%. An environment where, it wasn't a robust quarter, particularly with how the Easter shift affected the end of the quarter. So, I think we felt good about that. We're just finishing up the second quarter and getting ready for earnings. So I got to be a little bit careful about what we talk about, particularly in the second quarter. I'll tell you what we've publicly disclosed, which was, RevPAR up about 4.5% in April and 6.5% in May. And so, I think the trends generally have been, pretty stable across the industry. For us, our story is really an urban story. And I think you're seeing that, more broadly across the industry. The better growth is coming from some of the lagging location types, some of the lagging markets. And for us, half of our portfolio is urban, another 25% suburban. We don't have as much of the pure play resort exposure, which is where I think you're seeing maybe a little bit more pressure on leisure rates versus last year, I think, which is really more of a comp issue than it is any type of absolute softness. But again, for us, it's an urban story. More specifically, we have exposure to 5 or 6 markets, kind of the San Francisco, Silicon Valley market, Minneapolis, Baltimore, Louisville, New Orleans. Those markets are driving the majority of our growth. Collectively, those markets were up 13% in RevPAR in the first quarter. We expect those trends to continue, not necessarily because they're super strong markets, but because they're just growing off of a lower baseline. And so, collectively, that's about $20 million in EBITDA between those markets. It's, almost 10% of our overall corporate EBITDA. So we think there's still great upside to come in the portfolios. You continue to see some of these, particularly these lagging markets, recover.
So I got a lot of questions, but you've answered a lot of them. One of them is those lagging markets. It is. Those aren't amazing markets. They're just markets that were coming up off of the bottom, which is interesting where we were versus the leisure markets that were at the top that have all fallen. So it's funny.
Yeah, look, that's right. I mean, the anecdote I've used over and over is, our RevPAR in Minneapolis, we have two hotels in downtown Minneapolis. In the first quarter, we were up 16% year over year. We ran 45% occupancy for the quarter. I'm not necessarily proud of that occupancy, but it does, one, it's the first quarter in Minneapolis. It's obviously the slower seasonal period of the year. But I do think that it highlights that there's just a lot of embedded growth in some of these markets that have been much slower to recover. And when you contrast that with what's happened in the resort and the leisure space. People are talking about resort and leisure softness in a way that really you can only measure year over year or measure versus rates that we saw in 22 and 23, which were atypical. They're still 30 or 40% oftentimes above where we were versus 2019. I really wish we could come up with another word other than normalization because it's become so overused. But I do think that's what you're seeing from a leisure perspective is you're just seeing rates that reflect people going back to more normal historical travel trends. Not everybody has to drive to the beach in Florida to vacation. You can go on cruises, you can go to Europe, you can do all these things that really weren't an option in 2021 and 2020.
Yeah, we're seeing similar stuff. Florida's down and New Jersey is up, and that's
Yeah,
not been a story. So that's fun. I also think it's interesting that you said that, so your RevPAR is up, which is great for lots of months, lots of quarters. I'm going to dive into that. It's been occupancy, it sounds like, not rate, which is what everyone's seeing.
that's right.
You then also added that your EBITDA is up and your margins are better, which you attributed to your team, which I will too, because that is not what we're seeing. We're seeing EBITDA
Yeah.
erosion and the expense pressure. So we're seeing that erosion. So kudos to you and the team.
Yeah, look, I think the team did, particularly in the first quarter, a remarkable job. On 1.5% RevPAR growth, all of which, as you alluded to, was our rates were actually flat to modestly down in the first quarter. Our expenses on a per occupied room growth basis were actually negative year over year, and so to get 90 basis points of margin expansion off of that type of top line growth, I would say is atypical. I think where we see the opportunity from an expense perspective, one is again you are seeing wage pressure abate to some extent. We had multiple years of well above inflationary growth from a wage perspective, particularly hourly wages. That has moderated significantly. And then, we've become reliant, our portfolio specifically, and I think the industry broadly has become more reliant on contract labor, which is more expensive and less efficient. And I think the opportunity set has been actually to hire more full-time employees. And so we used to measure FTE counts and say, gosh, I'm so happy we're only at 75 or 80% of 2019 levels. I'm actually excited when I see that number tick up a little bit because it means we're replacing contract labor. I don't think we ever go back to 2019 levels from an FTE count perspective. I think we've created some efficiencies in this business that will benefit the operational efficiencies of our hotels over the longer term. But I do think there's a real opportunity to one, replace contract labor, and then two, to reduce the amount of turnover. And every macro indication suggests that the labor market continues to soften. It's softening from a really, really firm position, so there's a long way to go. But that's the opportunity set. Despite the fact that RevPAR growth may not be as high on an absolute basis as we'd like it, we do have opportunities, I think, on the expense side going forward. I think we're just at the beginning of that. It's still hard out there. I think if you lined up our operating team and said, tell me what your biggest challenge is, I think labor would still be number one on their list.
Yeah, we're hearing that a lot. Well, let's dive into PIPs and renovations, but what else are you guys working on, spending your time on? I mean, we buying stuff, we selling stuff. I know you sold a handful. What are we spending our time and energy on?
Yeah, we've sold. We've been a net seller. We sold over the last 12 months. We sold 9 assets. We've sold for about $130 million. We've been pretty strategic and I think very targeted in what we sold. We sold that on a blended basis at about a 5.5% all-in cap rate. We don't have a lot of it, but we really targeted some of the legacy lower RevPAR, lower margin, higher CapEx needs assets where we could find a local owner operator that was a per pound or a per key buyer that was a little less focused on the going in cap rate. And it did a couple of things for us. One, it cleaned up some of the lower end of our portfolio, but it also eliminated about $45 million of near term CapEx spend. And I think if you look at for a common thread or a common theme across what we sold, it's really that. I think one of the underappreciated stories in our industry is this business just hasn't had the CapEx spend put into it that it needs to. And, at some point, there's a day of reckoning for that. And we're trying to be very thoughtful around where we're spending our CapEx dollars. The cost of renovations for these type of hotels are 25, 30, maybe even more percent higher than they were in 19. And we're dealing with revenues that are, slightly ahead, but not meaningfully ahead, just on a nominal basis where they were in 19. So when you think about your CapEx obligations as a percentage of revenue or EBITDA, it's just a bigger obligation than it has been historically. So we're trying again to be very thoughtful around where we spend those CapEx dollars. And that has been, again, kind of a common thread amongst what we've sold. We'd like to get back to a point where we can be acquisitive. I think that when the Summit stock story has worked the best, it has been when we've had a cost of capital to raise equity and go buy assets. And, like our peers, like we haven't been in that position for some period of time. I do think it's a real big part of kind of the value creation thesis of what we do. I think we're great at identifying acquisition opportunities. I think we're really good at putting business plans in place and then going out and executing them. And we've got a good track record here that if you look at the $1 billion of assets we bought since the pandemic, they've performed very, very well, despite the fact that, market conditions have softened to some degree over the last 6 to 12 months.
So how do we get to that point where you can be inquisitive, or maybe when do we get to that point?
Yeah. Look, I wish I had a perfect answer to that. I think, part of it is going to be, public market sentiment for us has to change, for the industry has to change. And I think that, the industry's facing two things, particularly in a public context. You're facing monetary policy uncertainty and you're facing fundamental uncertainty. And the combination of those two things has created an environment where sentiment towards public lodging stocks has been, really fairly negative for the last 12 months. We have a history of this. This has happened over and over and over in our industry. It always turns. When it turns, I wish I knew. I don't really know. I do think we'll start to get some better clarity around the direction of our monetary policy later in the year. I think it'll be helpful to get, through the election. But I think at some point there's a re-rating for all the public company stocks to look something more like an early cycle type of multiple. I think the multi-year longer term outlook for the business is really pretty positive. There's very little supply growth. I think there's very favorable secular demand shifts that are helping lodging broadly. People want to travel. That's a very good thing for hotels. We've seen really no signs of those trends abating. And I think you're still at different phases of the recovery when you look specifically at business travel, where I think there's still room to grow. So that doesn't resonate with public company investors right now. They care about like what, the week of July 15th RevPAR is, not what 2025 or 26 RevPAR is. History would suggest that will change over time.
Yeah, I'm glad you're on now. You're unofficially speaking for all of the publicly traded REITs. So,
yeah.
So let's continue. But I will say your counterparts are all sort of doing the same thing. No one is very active. Everyone's stock price is sort of down. I would argue they're using the majority of their time to simply renovate their existing assets. There's no buying, there's no selling, there's very few transactions. They're asset managing what they have, which for all of us seems really boring, even though it may be the right thing to do. Seems boring.
And it's not the most exciting in the brokerage business. I can certainly understand.
Terrible decisions. Do you think it makes sense? Do you think it makes economic sense to renovate the assets, or should you just ride them to the end, pass it along, let the next guy spend the time and energy and money?
Yeah, look, I think it depends, right? Like, I don't think there's a blanket answer to that. We've had to be really thoughtful around how we allocate, kind of our free cash flow dollars, whether it's acquisitions or dividend increases or renovations. I mean, we could spend every last dime of our free cash flow this year and the next couple of years just renovating assets. In the 9 assets that we sold, it just didn't make sense. We thought we did find a buyer who would take a different view on the capital requirements for the hotels. We think that there was a better use of our capital elsewhere. In many instances, that's renovating a hotel that probably has a better growth profile. And so I do think you've got to be very cognizant of what the market dynamics are, and be thoughtful around which assets you're renovating and which assets you're not renovating, and what the scopes of those renovations look like. But again, I do think that while in the near term it's a little bit painful, I do think longer term it's going to create buying opportunities for those of us that are better capitalized. There's only so long you can kick the can without renovating and seeing a real material impact on your top line results.
And listen, I'm a biased, greedy broker, but we think that you can sell at 5 caps, like you just proved that you did. And I know there's people out there like, why would anyone pay a 5 cap? It's why we have a job. Again, it's why I love the industry, because you can. One man's trash, another man's treasure, right? They can buy it. I'll buy it from you for a 5 cap because I know that asset better. It's either my next door neighbor or I just know what I've done because I've done it before. I can renovate it cheaper than the next person. I can improve operations. I can fix something, whether changing a brand or not, changing management, changing operations, improve efficiencies, and a 5 cap becomes a 10 cap. Thank you very much.
That's the sell the dream approach for sure. And again, it's worked for us because we did have a handful of these smaller assets where the check size was pretty manageable. You could get a local lender to finance it. The improvements you've seen in the CMBS market have certainly helped from an institutional perspective, but debt's still expensive. And so that's really the needle that we've tried to thread is to be able to find the smaller local owner operator that is going to self-manage and feels like there's upside from taking out an institutional manager, and frankly probably is just going to spend less on the renovation than a more institutional owner would.
Talk to me. We totally agree. That's what we're seeing. And when does that change? When does it go from the small guy? When does the institution come back?
Yeah, look, I think again, I think you need to see the cost of debt come down. I think when you canvass, the really smart big capital allocators across the space, across industries, across the capital structure, I still think the incremental dollar is going to credit. I think the spreads you can get on, what isn't pretty good debt yield last dollar mezz is pretty attractive when, you're talking, teens type of debt, in place current interest rates, decent debt yields. It's hard to go out and buy 5 cap assets when you can allocate your money there. And I think I still think that's where the incremental dollar is going from some of the more diversified institutional investors.
Yeah, I mean, even personally, as long as I can buy, treasuries at 5%, that feels pretty good. Thanks. Why do I want to go buy a hotel and take risk?
Yeah.
Same thing.
Yeah. Look, lower interest rates helps for a whole lot of reasons. I don't know how much we can hang our hat on that happening later in the year. I know the curve is certainly suggesting we're going to get a couple of cuts by the end of the year. I hope it's true. But I think that, we felt coming into the year that rates were going to be higher for longer. And that has played out. We don't typically try to bet on the yield curve. We did swap a bunch of debt early in the year because we just never bought off on this yield curve that implied 6 rate cuts for the back half of the year. That has played out. I do think you're seeing signs of, broadly speaking, a slowing economy. I think the macro data that's coming out is suggesting that, as you would expect, the higher rate environment that we've had for the last 18 to 24 months is slowing the economy down. Hopefully it's putting the Fed in a position where whether or not they cut, they're at least able to start to signal that we're on the path to those cuts. We thought we were there, back in December of last year when the Fed pivot talk started. It turned out to be a little bit of a false start, and hopefully we can get back to that point. The dynamics around the election may change the timing of that to some extent, but I do think that certainty around monetary policy is every bit as important as the actual direction, and hopefully we get some positive news on both over the next 6 months or so.
But how concerned are you with if they lower rates? That you just said things are slowing, so that's counterproductive, if that makes sense. You have to have slowing in order to lower rates. Does that concern you?
Yeah, look, I think that, I think it's part of why you see these broad disconnects in the public markets in terms of where the stocks trade relative to NAV. I think that there's a heightened sense of concern amongst investors on the health of the consumer, and you can point to, whether it's credit card delinquencies or excess savings from COVID that have gone away. You can point to some things that give you concern for the outlook of the consumer. I don't think you've seen it show up in consumer spending. And I don't think you've seen it show up in hotel demand. You certainly haven't seen it show up in broad travel statistics. TSA is setting records over the 4th of July for people traveling. And so you do worry about that. Again, I look at a couple things that I think help mitigate, lodging versus a broadly softening economy. One is there's just no supply, and we haven't been in this environment. We've been in this environment now for a couple of years, but if you go back to the 3 or 4 years pre-pandemic, the industry supply was growing 4 or 5%. We're going to have 4 or 5, maybe more years of 1% or less supply growth. So I think that helps to a certain extent. And as I said earlier, I think travel continues to still wallet share. For all the people that they're all the consternation about consumer spending, I've yet to come across the consumer that says, we're going to cut our summer vacation this year. I just think that it's a priority in a way that it hasn't always been a priority. It's more of a priority than it has been perhaps in the past.
Yeah, people are choosing it over experiences, over stuff, right? Over other things.
Exactly.
So we
Yeah.
get there. So I'm curious. You're talking all the macro stuff. Why I'm thinking M&A, and why haven't you guys been bought yet? Why haven't you been taken private? I'm going Hertha. I'm going Ashford. Why not anybody else? Get
Yeah.
expensive. You guys are too expensive. Like, why hasn't there been more activity?
Well, look, I think the stocks, I think if, you got all my peers on this call, I think they'd all say their stock's cheap. I don't think
Right.
anybody loves the valuation of the business. And that's part of it, right? And I think that, what's a little bit different is, these companies are all well capitalized. People are lowly leveraged. They have a lot of liquidity. They're similar to what's happened in the asset level transaction market. Nobody has to sell. And it's expensive. The equity checks for most of these businesses are $1 billion plus, and there's still a limited a buyer pool that can write that check, and they still are very dependent on the credit markets, and to lever it at the levels that the most likely buyers level it at, that the all-in rates on hotel debt still can be 8 or 9%, and so I think it's really hard to make kind of the LBO privatization math work in this environment, particularly when I think the views broadly are that there's pretty steep discounts to NAV. Look, that being said, we get asked this question in almost every panel we do. Whether we think there's going to be more or fewer public lodging REITs in 6, 12, 18 months, 24 months, and I continue to say fewer. I do think that you will see privatizations or mergers in some of these businesses. I don't know that it's today for all the reasons that we just kind of talked about, but I do think that as you start to see rates come down and the credit markets recover, I don't think that there is the resistance to selling that may have otherwise been the perception pre-pandemic.
I think I agree with you. And the things I can't see, and part of that is everybody's happy and nobody wants to lose a job, and things of that nature. But I do think once credit gets cheaper, I think everybody's looking. I know the conversations, everybody's been looking, so they're waiting for the right.
Yeah, look, I just don't think that like the social issues are the impediment that folks want to blame on. I think the impediments are capital markets
Agreed.
impediments today,
So
and to some extent some fundamental uncertainty, but more the former than the latter.
I totally agree. And I still think everybody's bullish. I mean, you're bullish on your company. You think our stock price is low and you're going to grow it. And I bet it's higher a year from now than it is today, along
Yeah,
with everybody.
yeah. Look, I think everybody would say that. We certainly believe that. Some of it again is this exposure to markets that we think have got a long recovery leg coming to them. But yeah, we absolutely believe that.
All right, give me the rest of your future outlook. What do you keep thinking the rest of the balance of this year is going to look like?
Yeah, look, I think that I think you're going to see more of the same. From an operations perspective, I think you're going to see better performance in urban markets. I think you're going to see better performance midweek than you are on the weekends. I think you're going to continue to see pure play leisure, pure play resorts lag. I think people are going to talk about how soft it is, and I'm going to say it again. Like I think that it's normalization, not real absolute secular demand trends that are softening from a leisure perspective. And so, I think we're going to kind of continue to churn along from an industry perspective. Like we've everybody sees kind of the Smith Travel numbers outside of the disruption around Juneteenth. I think the industry continues to kind of plot along with, as I said, urban markets and suburban markets outperforming and midweek business outperforming the weekend business. That's my expectation for the balance of the year. I don't have like I can't give you the date when I think the transaction spigot turns on. I do think it turns on, and I say that with probably more conviction today than I've said it with over the last 12 months. Is I'm starting, and I think a lot of it's going to be facilitated by seller capitulation. I just think that you're starting to hear more sellers who are one, the ability to kick the can has been there. It doesn't go on forever, and it may be less of a lender issue, and it may be more of a brand standard issue or a PIP or a renovation issue. I think if you get a little bit of tailwinds from the capital markets, I think you'll see a lot of folks just say, I've waited it out. My time is now. And so, does that happen, in the next 6 months? I don't really know. Again, I think getting clarity on the direction of where monetary policy is going, and getting past the election, both will be positives for the industry.
I've been saying, heck, for the last 24 months that I think today is better than tomorrow. And I think I'm an optimist. So obviously that's a negative sentiment,
Yeah.
but unfortunately I think I've been right. And I don't think my opinion's changed. So I don't know. What's your opinion? Is today better than tomorrow or
Yeah. Yeah, look, broadly speaking, look, you have been right. I remember having this conversation with you, probably 12 and 24 months ago, and I was surprised, and I was like, well, yeah, of course the broker wants to sell today. Come on, and I know that's been your.
Jon said Teague was right.
I know that's been your stance, and look, you were right. I don't, I don't know. I think for us, as we look at it, very much on kind of an individual asset level. And
Agreed.
so there are still some assets in our portfolio where I think the strike today makes sense, particularly if I've got a renovation coming due over the next 12 months. There are also some assets in our portfolio where I could probably sell them and I'd hate the price. And I think I'm better. Some of these markets that I just talked to you about, like you shouldn't expect us to go double down in Baltimore or Minneapolis or Louisville. I think even you would tell me like you probably don't want to sell those today, because the buyer you're going to get is a distressed buyer buying off of highly impaired cash flows, at least temporarily impaired cash flows. Like I think I'm better off letting the cash flows of those hotels recover, which is happening now, and two, selling into a little bit better capital markets environment. But I think the point you highlight that's been absolutely true is I think as an industry, we've been hanging on to a better capital markets environment being around the corner for 12 months, and it hasn't materialized. And again, I do think it will happen, but I think the part of why sellers start to capitulate is because it just hasn't materialized. And at some point, transactions need to happen.
I have some assets in Baltimore, Minneapolis, New Orleans, San Francisco that I'd love to sell you. You let me know.
We're a buyer. You might not love the pricing, but there's a price for everything, as they say.
I think that this is great, Jon. Thank you very much for coming on and doing this. But some good news out there. One, I think that our industry, maybe the financial industry, learned we're not over-levered for the most part. We're not seeing banks overly struggling. We're not seeing a lot of distressed stuff that banks are selling. We're having asset sales where the equity, the borrower, and the debt are coming to us together, making a decision. Often equity is wiped out, and the lender is making the decision, and that lender is making the decision to sell because they don't want them back. And we are definitely starting to get those and have had those, but that's not the majority of what we're trading. The majority is what you just said. I've got a PIP coming due and I need to trade, or I have a loan maturity and I can't refinance. I don't want to write a check to right size the equity. So let's transact.
Yeah.
Where our volume, be it where we are, is been just fine. Thank you very much.
Yeah. Well, good. Look, I think obviously it's an encouraging, stat. And I think that's, I think that's exactly right. I think people get a little too fixated on distress and when are we going to see distress and less focused on when are we going to see highly motivated sellers. And I think the environment for having a lot of highly motivated sellers is certainly going to be there.
I think we're there-ish. Again, they don't want to, but they're trading. Hey, we don't see it turn around anytime quickly. So let's make the tough decisions and move on. That's what I am. So anyway, Jon, I love it. Thank you for coming on. This is great. When am I going to see you again next?
Soon. My pleasure. I don't know, but we need to get together soon. This is always fun. I always appreciate the
you hosting me or am I hosting you? I can't remember.
I think it's probably my turn. So Austin, it is. Well, let's wait till it's mid-August. We got another 10 degrees hotter to get, and then it'll be perfect.
Yeah, perfect. And then like a 2-hour baseball game where we don't sit down.
That's right. It's great. Perfect.
Jon, thanks. Hugs and cheers to the family and everything you're doing. Good luck with your Q2 report. I wish you the best.
Appreciate it. Thanks, Teague.
Thanks, brother. Bye.